Right, good morning everyone as we head into trade for the week on Monday the 7th of August. Now we'll have a quick look back to last week, and we'll have a look at the movements over the course of last week, as we did have some sizable moves across a number of different asset classes. Now you can see yields higher, longer dated yields, the yields on the 10-year in the US rallying hard, and then yields in the 2-year not really budging, just chopping sideways. Now that is off bets for the Fed to achieve a soft landing, something they would hope for, a soft landing in the economy. Now they are getting inflation under control. Inflation is cooling off, but economic data remains positive. So in order to, like, hiking interest rates and cooling down inflation but still managing to avoid a recession is obviously the hopeful scenario, or the scenario that they would hope for. But no, there still is potential trouble ahead with the lag effects of interest rate hikes still yet to take effect. So certainly not a foregone conclusion for that to be the eventuality, but bets for a soft landing to be achieved ramped up over the course of last week. Now you can see solid upside across Monday, Tuesday, Wednesday, Thursday in the 10-year, while the 2-year was not budging. So longer dated yields positive off the back of positivity surrounding the economy. Now that had implications across a number of different markets. Gold is sensitive to movements in bond yields, so solid downside over the beginning of the week in terms of gold, but you can see downside in the Aussie, downside in the Kiwi, Euro, and Sterling to start the week. Now Australian dollar, the Aussie, was driven lower with the fact that the RBA did hold interest rates at 4.1% for 2 months in a row, and barring any upside surprise to inflation, you'd have to imagine that their hiking cycle has concluded. The Kiwi dollar then drops in line with that. You can see dollar Swiss pushing higher to start the week, dollar CAD pushing higher to start the week. You can see dollar yen pushing higher to start the week. That cooled off a little bit as we got into Thursday, Friday across the US dollar, with the bounce back in the US dollar, or the sell off in the US dollar after the rally, coming off the back of that mixed jobs report from Friday. You can see, if we have a look at stock indexes, that upside in yields drove the S&P, the Dow Jones, the Nasdaq, and the Russell all lower, which in turn then drove the DAX, the Euro stocks, and the FTSE all lower as well. So stock index weakness across the board yesterday, off the back of that stock index weakness across the board, off the back of that rise in yields, which is obviously has widespread implications across financial markets. US dollar strength, stock index downside, gold downside is the expected reaction to that higher than anticipated, or those aggressive moves higher in yield. Sorry. Unemployment rate and NFP on Friday of last week put a pause to that and caused yields to sell off. You see NFP slightly below consensus, which is not the best thing in the world, but the unemployment rate ticking lower, wage growth remaining strong, which signals an underlying strength and underlying strength and robustness continuing in the labor market. With these interest rate hikes, you would expect the unemployment to then rise as the economy cools down, but numbers remain strong, labor market remains strong, growth remains strong, just inflation coming down, which has not come down in the way maybe central banks would have hoped, and is still too high. There is still work to be done in terms of keeping interest rates at elevated levels in order to get inflation completely under control. But that's a look back to last week. Onto this week, we do have some inflation prints from the US. Now, no high impact data today, nothing really of note tomorrow. I doubt that changes too much of the RBA's thinking. Inflation in China, expected from minus 0.3% in terms of the yearly figure. So we'll have to see how that impacts markets on Wednesday morning. But the main focus of attention is going to be Thursday out of the US and Friday morning from the UK. Now GDP out of the UK is maybe a little bit trickier with the UK. It is the preliminary figures for Q2, so it'll be interesting to see how the economy has fared with those interest rate hikes. Did have the Bank of England last week suggesting that they would kind of pushing back slightly on the I forgot to mention it last week, but too focused on yields, but did mention the fact that the further hikes of interest rates are not a foregone conclusion in the UK. They probably will continue to hike interest rates, but you know, maybe not to the 7%, or certainly not to the 7% that some market participants had been hoping and predicting for. So, maybe one more hike from the Bank of England. They will want to see how their current interest rate is going to affect the economy going forward. Inflation has now started to cool down in the UK. They will want that to continue in the second half of this year, which is what they were suggesting over the first half of this year. So they will want to hike too high. They will want to hike to a point where inflation will come down, but not kind of cripple the economy. But growth figures obviously give us an idea of how much the economy is being constrained. CPI from the US, you can see the core CPI print and you can see the total rate of inflation. Now, interesting print we've got here. You can see the inflation print is CPI, the headline figure at 130. Well, they're all at 130, but the headline CPI print consensus is for that to be at 3.3%. So we're expected to see a slight uptick in inflation, and we're now getting to the sort of level where it is expected to be tricky for inflation to cool down more than it has done. A 3% inflation rate is still too high, but you have to remember this is still 2% higher than the 10% it was last year, than the 8% or 7% it was the year before. So in terms of cumulative percentages, probably like 25% over the course of the last 3 years. So just a 3% interest rate. Okay, the news source will tell you it's back to the Fed's preferred or back to the Fed's target range, and inflation has cooled down, but still 25% higher than it was a couple of years ago. So the people who don't understand inflation probably think that's absolutely fine, but for us people in markets and who understand economics, we know it's still. Now, prices will never go back to where they were, but that is the situation that we all have to deal with. But consensus 3.3. Now, this could get a bit messy if this comes in above consensus. You got the core CPI print, 0.2% growth over the month is fine, but for both measures, but that comes in 0.4, 0.5. This comes in 0.4, 0.5 with positive economic data over the month of July, with rising oil prices over the month of July. I do think there are some risks skewed to the upside for these prints coming on Thursday. Now, it is only Monday, so we do need to give a bit of time and wait till Thursday to see how markets position themselves ahead of the event. But I do think there is scope for a stronger than anticipated inflation print, which would solidify another 25 basis point hike from the Fed at their meeting next month. We've had strong economic data, we've had strong growth, strong inflation, strong labor market figures. Does not make for a situation where the Fed stop hiking interest rates. So it's probably what we'd like to see in terms of some movement that should spark some upside in the dollar, some downside in stocks. And if I was a betting man, which I am, that is the bet I would place at the start of the week. Obviously, we've got a few days to digest price action, continue up to date with the news flow, see what markets have to say before we reach that on Thursday. But not a great deal between now and Thursday. It can go one of two ways. Markets can continue on their trends, your cross asset correlations can play out, or markets chop sideways until CPI on Thursday. We'll update more on that on Thursday as we get around to it, but for now, that is how we're looking as we head into this week trading.